The most profitable market in the world right now doesn't sell software, oil, or real estate. It sells absolute nothingness. Specifically, it sells a concept economists call a Veblen good. In the summer of 2023, French billionaire Bernard Arnault briefly became the richest person on Earth. He didn't achieve this by discovering clean energy, building a sovereign software network, or revolutionizing global logistics. He did it by exploiting a glitch in human psychology that breaks the fundamental laws of capitalism. By now, you probably understood what the glitch is. It's selling status. Let's try to understand how it works. If a tech company raises the price of its microchips, sales drop. If an oil conglomerate raises the price of crude, nations look for alternatives. This is the bedrock of classical economics: supply, demand, and price discovery. But there is a hidden $300 billion sector of the global economy where this rule completely reverses. A sector where the more expensive a product becomes, the more the public desperately craves it. To understand how Wall Street weaponized this anomaly, we have to look past the marketing, the runways, and the celebrity endorsements. We have to look at a 125-year-old economic framework known as the Veblen trap. And once you see it, you realize that the luxury industry isn't in the business of selling physical goods. They are in the asset asymmetry business. In 1899, institutional economist Thorstein Veblen noticed a terrifying structural shift in the Gilded Age middle class. He coined the term conspicuous consumption. Veblen realized that in a hyper-capitalist society, utility scales inversely with price. A $50 plastic watch tells the exact same time as a $50,000 Swiss timepiece. In fact, the mechanical Swiss watch is technically less accurate. Therefore, the consumer is explicitly paying a premium for operational inefficiency. When you analyze the financial balance sheets of premium status brands, their gross profit margins consistently hover between 70% and 85%. A premium leather handbag that retails for $3,500 costs roughly $180 to manufacture, package, and ship. The remaining $3,320 is a pure wealth extraction tax. It is the literal price the consumer pays to prove to their peers that they have capital to incinerate. But how do these conglomerates maintain the illusion of value? They do it through aggressive, coordinated supply destruction. In 2018, fashion house Burberry sparked public outrage when financial filings revealed they burned over $37 million worth of their own unsold clothing and cosmetics. To a layman, this looks like corporate insanity. To a luxury CFO, it is a routine risk mitigation strategy. If unsold inventory is discounted to clear space, the status ecosystem instantly collapses. The product must remain scarce, even if it means destroying physical assets. The ultimate irony of modern status economics is who is actually financing it. High net worth individuals, the truly wealthy, are increasingly shifting toward what sociologists call inconspicuous consumption. They spend capital on elite education, private healthcare, and invisible tax shields. Meanwhile, the luxury industry's fastest growing demographic is the middle and lower middle class. Status has become a financial defense mechanism. For an individual with no upward economic mobility, buying a luxury logo is a desperate attempt to purchase immediate synthetic equity in a social class they don't belong to. In the final analysis, selling status is the most resilient business model ever engineered because it capitalizes on an infinite resource. Markets will crash, real estate bubbles will burst, and currencies will devalue. But as long as society values the appearance of wealth over the accumulation of actual financial independence, the Veblen trap will remain open, and Wall Street will always be there to collect the fee.